everybody, and welcome to another edition of Investing Education Academy's podcast. So, for those of you all who are wondering, what is the topic today? We're gonna talk about the effects of the Federal Reserve's rate hike. We've been talking about this on and off for since really November, and some of you all may be wondering, why is this topic keep coming up? Because it's very important to the volatility that you're seeing inside of the stock market. So, with that being said, I'm gonna do a slight bit of housekeeping while Leon tells you more about this topic.
Yeah, so today's a big day. We've been talking about this since, like Brent said, since November. Um, People in the business call it Fed Day, so happy Fed Day to everybody. So what happened today was the thing that's been causing all this freaking volatility in the market began today, right? And the reason I say began is because the Fed has signaled that they're going to raise rates probably 6 times this year, and that is like mind blowing in the world of finance to for that many rate hikes. But we'll take a step back and just kind of explain why this even matters, right? So first, I'm going to talk about not the stock market, but just your general kind of finances, right? So the rate the Fed is raising affects anything that deals with the prime rate. So you get like a credit card, it'll say like prime plus 3% or whatever. So it'll affect. So your credit card rates are going to go up. The other things it's going to affect. It's also going to affect. So let me say this: anything that has an adjustable rate or a variable rate are going to go up pretty much immediately. You're going to start seeing those rates tick up on your credit cards. If you have like an adjustable rate mortgage, you'll see that start to rise. And I don't know what other kind of adjustment. Maybe I don't know if you
Yeah,
adjustable rate.
you have balloons. You have some people have monthly resets on hard money loans.
Mhm.
So yeah, all of it's going up.
Yeah, anything that's not a fixed loan will go up in real time. Like it'll start to go up as they're raising. Other side of that now is if you have a fixed rate, you're fine for that current. If you have a current loan that has a fixed rate, you're fine. You're not going to see anything go up. But if you're in the market to take out a loan that has a fixed rate, you're going to pay more than you would have paid like yesterday, right? So let's say if you're going in to get a mortgage or a car loan, rates are rising right now. They rose today. So yesterday you would have paid less in interest rate than you'll pay today or tomorrow because rates are going up and these are adjusted in real time.
So
So
Leon, just
mhm.
for those of you all who've been following us since November, I'm trying to think of a good way to say, but this is the reason why you want to listen. Leon and I, we were at the car dealership. What was it? December,
two months ago.
2 months ago, because we were trying to get ahead of this thing. Like we knew it was coming. We were like, okay, we need to make a decision. Made it very quickly. Took care of some things, and as a result, today when these rates tick up, those people who were on the fence or maybe thought it really wasn't going to happen, when you go to get your cars, it's going to cost more than what it cost when we made a purchase recently. So these are the reasons why you want to listen and act on this information. Now, Leon and I don't yell, we don't scream, we're not very animated. So sometimes I think this information kind of falls on deaf ears, but we're using this as an example to say in the future, please understand there's reasons why we bring this information up. And we are hoping that you are taking advantage of it because we say it all the time. We were going to do this anyway. We can walk outside and you can see an example of that. It's like we took advantage of this information that we had, and we hope that you do as well.
Yeah. I mean, yeah, exactly. Like saw it coming, took advantage of it, locked in a lower rate. Because, like I was saying, if you think fixed rates are not going to be affected, they are. Where they're not going to be affected is if you already have a fixed rate, you're fine. Anyone going out to get a new loan that has a fixed rate, you're still going to pay a higher rate. So this is why it's very, very important. And like I said, this was the first one, right? This today was the first one. They're going to do it. The next one is going to be in May. So I think the Fed meets like every 2 months or so. So essentially, every meeting through the end of the year, they're going to raise rates, and they said they're going to be data dependent. So what that means is, if they don't see rates coming down quickly, well, not sorry, they don't see inflation kind of starting to taper down some. This is only a quarter point raise, right? The fear was that today they were going to raise a 0.5%. 0.50. They didn't do that. And we'll talk about the market in a minute, but that's why the market was kind of happy. But they have not ruled out raising 0.5%. And again, what that means is if they do that in the future, a couple months out, your credit card rates are going to go up very quickly. Any adjustable rate loans you have are going to go up very quickly. And then anybody that's in the market for a fixed loan, as you're getting that new fixed loan, your rates are going to be a lot higher. So this rate hike thing is very serious. And and the reason they're doing this, they're actually doing this so you don't go out and get loans. Because the problem with what's causing all this inflation right now, we said this before, is that there's so much money in the system right now that's chasing too few goods. We had all the stimulus money back in the day, and then right now you can go get a loan for effectively zero, at least before today. You could pay, mortgage rates were like in the high 2s, maybe low 3s. Now mortgage rates are above 4% and rising. And they're doing this because they want everyone to stop borrowing money and stop buying stuff in such quantities to slow down inflation. So this is purposely done to stop to slow down the market. But for us, it's going to cost us real dollars. So as these rates rise, you're going to start seeing, this is going to add. I was seeing some numbers before, but based on mortgages and interest rate and credit cards, this is going to add hundreds of dollars more per month for certain loans that people have outstanding, and that's tough in a market where in an economy where inflation is running rampant, right? Everything is expensive right now. Now think about trying to add on another few $100s to your credit card bill, or your mortgage, or your car loan. It gets tough. So if you can, try to refinance now, because rates are rising, and they're going to be rising rather quickly. So that's the so Brent, you got anything on that?
Yeah. Also, too, if you're a real estate investor, or if you're an investor of any type where you take out loans to secure a property or an asset, it's going to cost you more money as an investor, which means your profit margins are going to either shrink or cause it to not be an investment that you want to make anymore. So these things don't just affect people who are buying a house for themselves or people who are buying a car for themselves. It's also going to affect investors. It's going to affect businesses as well, but we're probably going to dive into that a little bit. So I'll hold off on that one. And we got a comment that came in saying, basically a person feels bad for anyone buying a house or a car right now. Inflated prices are higher. That's true, in addition to gas prices being higher. Mm-hmm. But you have to think, sometimes we have to make these decisions based off of a budget. Is it a need or is it a want? Essentially, this is that time period where you want to ask yourself, am I doing this because I have a need, a legitimate need, or is it in your mind a legitimate want? And it doesn't, and we're not saying that all of a sudden we have to live like hermits and everybody save every dime you get. Enjoy your life. If you can afford to continue to do things, do them. But if you can't afford it, or if you need to do some planning, we are trying to tell you this ahead of time so you can start to adjust not only your mindset, but your budget, because it will change.
Yeah, the thing about the comment about the car and the house is true. Like I said, this whole rate thing really started in November. If you went and bought a car or a house, mid last year, mortgage rate, you could have paid, your rate would have been maybe high 2s, maybe low 3s. Now mortgage rates are about 4%. Like I said, they're rising. They're going to get deep into the 4s, maybe into the 5s. Car loans, same thing. Rates were considerably lower 6 months ago, and now you're going to pay considerably more. And the fact, like the person said, just the sheer cost of the house and the sheer cost of cars are just inflated right now. Like I said, Brent and I went and looked, basically had a car purchase a couple months ago. Couldn't figure out how to say it. Purchased a car a couple months ago. And what was my thought? Well, take a step back. I was looking for a car, to purchase a car, even like 8 months ago, like early last year. And when I went there, I went to CarMax, and the guy told me, he was like, look, don't purchase it right now, because as of right now, and this was like, I don't know, July last year, he was saying car prices, used car prices, were up between 20 to 40% higher than they were the previous year. And he was saying, you may want to wait, because hopefully things will come down. Well, things have gotten worse, right? So used cars now, I think, are approaching 40 to 60% higher than they were pre-COVID. So think about paying that much higher plus a higher interest rate. Like it's just really hard in an environment where you're paying more for groceries, gas, clothes, medicine, everything's higher. So just, if you can refinance, if you're in something that you can, refinance now if you can, but just know that if you can't, you're going to start seeing higher payments for things like your mortgage if it's adjustable and credit cards. Okay, so that's like the finance side. Now let's talk about the market side. So we've been saying since November, get at a high valuation, non-profitable stocks because they are going to struggle in the market, and we were dead on. Right, some of them things. I mean, we're not one to toot our own horns, but this one, I mean, we nailed it because a lot of these stocks that all of us are in. I mean, I won some, Brent won some. A lot of people watching won some. The Zooms and the Telladocs that won in 2020 and 2021 are now down anywhere from 40 to 90%, and primarily because of rising interest rates. Because the reason for that is there's now competition for stocks. So people that have big money, billions or millions of dollars, they'd rather park it in a treasury bond that's paying them 3% than invest in something like Teladoc that could go out of business in a year, right? So they're going to go with the safer bet. So a lot of money is moving out of the stock market and into safer investments. So what happened today was Jerome Powell kept to his word. He said, he said, I think 2 weeks ago, he told Congress they're going to raise 25 basis points or a quarter point. They did that. Now, anybody who's watching like me, like Brent and I, the market shot up. The market was up. The NASDAQ was up, which is mostly tech stocks, was up about 3% today. Huge. The S&P was up, I think, a little over 2%. And the main reason was that people were worried that Jerome Powell was going to come out and raise rates by 50 basis points or 0.5%. Because inflation is running crazy rampant. Yeah. Inflation is running crazy rampant. So everybody was like, oh my God, he's going to try to really, slam on the brakes hard. He said, no, he's going to do 25 basis points. That's what they did. So the market loved it because the market's like, yes, we're not going to have what they call like a hard landing or really slam the brakes on the economy. But what he did say also is that they're going to raise, well, he didn't say this. So the Federal Reserve is made of what they call Fed governors. It's just people that oversee the Fed. That group is saying they're looking at doing 6 interest rate hikes this year. Sorry, 7. They've done 1 now, so 6 for the rest of the year. And like I said, it could be 50 basis points or 0.5%, or it could be more quarter basis points or quarter 25% of 1% in the future. So we don't know what's going to happen because they're saying data dependent. All that means is they're going to look at the data, see what it is, and then make their adjustment again at that time. So the next rate hike will be in May. So they pretty much said they're going to do 3, and they're saying after 3 they'll then be really data dependent. But
this one was data dependent.
Yeah, right. I mean, well, that's the thing. Like, a data dependent term is kind of BS because everything's data dependent. But because basically what they're saying is we're gonna do like 2 to 3, regardless of what the data is, just because we got to slow down inflation. And then once we do those, then we'll make an assessment based on the data if we do more. The Federal Reserve governors, they're saying they're looking at about 7 total, 6 more for the year. So what does that mean, right? So what that means is for us as investors, bonds and interest-bearing assets are going to be, again, more attractive to big money. So we're going to see a lot of this volatility as people, adjust positions, move money out, move money in, do what they got to do. We're going to see a lot of volatility for the rest of this year. I don't think it's going to be like we saw this first half of the year. I think that was just kind of like the reset of the market, being aware now we're in a rising rate environment. But I don't think we're going to see 2020, 2021 up plus I think we were up almost 30% the last 2 years. I don't think we'll see that this year.
No. And Leon, let me jump in real quick. So the comment came up: if anyone has credit cards that you are paying interest on, you need to pay that off before you do anything else. This is a scenario where we don't talk about this side of finance a lot, but you really should understand your budget. You should understand, what monies are going out, cash flow statement, basically. What money's going out, what money's coming in, what are you spending on expenses? And specifically, I want to elaborate on this, so thank you for this comment. This is an opportune time to take an inventory of all of your credit cards, what their interest rates are, and take a shot in the dark. Call the company and ask them if they'll lower your rate.
Yep.
It cannot hurt anything, and sometimes they will do it. So just, again, inventory of all your credit cards. Like, what are your credit cards? Figure out what the interest rate is associated to each credit card. Then figure out what your balance is on each card. Now, if you call the companies, they'll tell you monthly how much interest you're paying as well. I think that is very vital information because most of finance as a whole, the ecosystem of finance is emotion based. And if many of you all knew how much you were paying in interest alone, emotionally, it will reset you. But because we're so used to paying credit cards, we're so used to paying, for our car notes, we're so used to these types of debt, we don't think about them anymore. But some of us have the opportunity to pay these things down, but we're just throwing money out the window. And I'll put myself out there. I had a home equity line of credit, and I'm thinking, equity line of credit, I think it was 3.4%, and it was $24,000 or something. So again, 24,000. And actually, if you're an IA member, I'm going to do this whole process with you. I'm going to show you the real numbers. I don't know where we're going to do it, but Leon, remind me. Let's do it with the community.
Mm-hmm.
We're going to show you what happened when I called Navy Federal Credit Union. You will flip when you hear how much interest I would end up paying on $24,000 at 3.4% interest. It was more than $40,000. It was more than 40,000. Well, if you're a member, I'm going to put it out there like everything. I'm going to put the whole thing out there. I'm paying that thing off next week. And so it was, I was like, this is insane. So just look at your numbers, ask them, how much is the interest rate? Many credit cards now and mortgages will tell you how much you're spending in interest per month. It's a number I think we should all know, we should all hear, because it will change how you feel and have actions behind spending money on, using debt to acquire assets that in a lot of situations we don't need.
Yeah. I mean, like just I was just thinking about my situation because I know, credit cards, right? So like, I think the minimum payment on most of my cards is like $25 minimum. And I pay more than that. But there have been times where for whatever reason I would pay the 25. Just kind of get the card out of the way.
$24. What? Your overall balance must be like $200.
Yeah. Well, no, it's like four. Like four. So one card I had
a credit card. That's a temporary loan.
Well. So the outstanding balance I think on one is like 400 something, and the minimum balance is $25.
But I tell you, when you roll,
yeah, I know. But think about it. I'm paying $25, but only a portion of that is going to principal. So I'm thinking, I'm paying the whole $25 to pay off this card. No, only, say, I don't know, 10-20% of that may be going to interest, and the rest going to, actually, I know what it is. I think it's like, on $25, if I pay $25, I think like $2 or $3 is interest, which is like what, almost 10%.
No. I think you might be saying that backwards. Probably $2 or $3 is principal, and the rest is interest.
No, because it's like no, because it shows you. It'd be like, let me, you know what, I'll do like you, bro. I'll do mine too.
Yeah, because normally you're never gonna get 8. No, you're never. I'm going on record with this. You rarely ever will get 98% or 90% going towards principal.
Right. I'll look at it. But I know it. I mean, and like we're saying, you can look, like Brent said, you can look on your, or like I'm saying, you can look on your statement. It'll show you how much is going to principal and how much is going to interest. So whatever it is, whatever. Now, if you, like Brent said, if you look at that and you extrapolate that out over a year, you might be surprised how much money you're actually paying in interest. And think about it now, that's going to go up considerably over the course of this year because rates are rising. So back to the markets now. So as I was saying that, rates, this was the first rate hike. It's making other assets more attractive. Money's going to be coming in as stocks, going to other places, yada, yada, yada. But the good thing is that the reason rates are rising is because the economy is on fire, which is a great reason, right? So you also have to remember, inflation is being caused by so much money flooding the system from all the money we saved during COVID. Plus, remember, right now, there are more job openings in the U.S. right now than ever before in history of the country, at least the history since they've been keeping the number. And so right now, employees are in control. they're asking for huge amounts. They're asking for huge raises because they see what's going on in inflation, right? So there's a lot of money from stimulus money, and there's a lot of money just from people's salaries going up that are chasing all these goods that's driving up inflation, which means the economy is incredibly strong, which is a good thing. So, and we proved this before with the data showing that the years where the Federal Reserve actually raises rates, the stock market actually typically performs better than average. So on average, the stock market does 10% per year. I think the years they raise rates, it does like 12 or 14%. Those years. And the reason is because typically when the Fed raises rates, it's because the economy is so strong. And remember, the stock market is just a reflection over the long term. It's just a reflection of the U.S. economy. So the U.S. economy is strong. Eventually, after all these outside influences kind of subside, the stock market catches up, right? And it returns solid returns. So say all that to say, continue to stay away from non-profitable, high valuation companies. And the way you can look up valuations is you can Google it, just look up a company's PE ratio. And for point of comparison, right now, the S&P 500's PE is about, I think it's like 25. So if you see PEs that are like 200, 300, 400, or even 90, 100, that's high. That's a high value stock. That's one you may want to stay away from in this environment. You want things that are kind of more like the 25 to 50-ish, 60-ish range as far as PE. That just tells you if the stock is expensive or not. And then of course, profitability. If the company is not making profits, it only has growing revenues, you want to stay away from those too. Those are the ones, and I posted in the community a couple of days ago, the list of all the stocks that won huge in 2020, 2021. It's unbelievable how, I think the lowest one was down, or the highest, well, the one that looked the best, I'll say, was down like 40%. The rest of them were down 60, 70, 80, 90, 95% from their highs. So continue with that mantra.
Mm-hmm. Be wary of companies that are highly leveraged.
And
companies that are borrowing money to survive, they probably won't be here long. And so if you are just looking, and many of you all probably don't know, but companies, they'll just leverage money to get started. Like their first 10 years will all be, predicated on leverage money that they borrow. So in this environment, that's going to destroy their profit margins. And it's also going to cause investors to stay away from them. So if you're wondering, like, well, why do they get hurt in these environments? It's for the reasons Leon just said, in addition to the fact that their profit margins are destroyed, which kills their projections, which also no investors likes when they miss their estimates. And, a couple rate hikes, companies can easily miss their projections, and Wall Street will penalize them for it.
Yeah. Like I said, they can either go away, struggle because they can't pay down their debt, service debt, or like Brent said, their profits can be hugely affected. And remember, profits are what people on Wall Street pay for, right? So companies that have growing profits is why stock prices go up. And if a company, last year was reporting 15% growth in profits, but this year or maybe this year or next year they're going to report only like 5% because they have to service debt at a higher rate now, that stock is going to get punished. So yeah, you definitely want to look for stocks. You want to stay away from stocks that also have high leverage or high debt on the books. So those are really the main things from today. Just recapping again: stay away from high valuation, non-profitable companies in general, specifically tech, but in general. And also, in your personal life, like Brent said, take inventory of your outstanding debts. Call them up, try to refinance, either refinance or lower your interest rates, because this was just the first rate hike. We have possibly 6 more coming by the end of the year, which is, like I said, is going to can add hundreds of dollars per month more in debts that we're already paying.
Yep. So for everybody, we owe you 2 things, and those are going to be our stock picks. For people who are in our Facebook community, we're going to put one of the picks there. For those of you all who are part of the paid platform, you can actually go to IEAnow.com, well, actually IEAmembers.com. And once you get to IEAmembers.com, you can essentially see both of our picks and the history of our picks. So hold on, we just got a comment that came in. This is let me read this one. Credit card interest is the devil. I use credit cards with rewards for everything. Pay zero interest by paying them off every couple weeks. The credit cards pay me 1 to 2, 3 on rewards. Yes. Now, I'm not going to dive full into that, but I am going to say, if you are IA crypto bull, there is a cryptocurrency credit card that we found that actually is paying some of my bills right now and paying me 5% on top of that and paying me another 10% for the card, for what I'm doing with the card. So if you all, I mean, this thing is it's literally paying some of my bills right now. So I'm getting like 15% rate of return from the credit card company to me, and some of the IA crypto bulls are too, because we find some great stuff. So
yep.
And we've been doing that for at least 4 months now.
Couple months, yeah. It's been 4 or 5 months. Mm-hmm.
So there are deals out there, and if you don't understand the cryptocurrency world and the space, it's just hey,
it's out.
It's just
and I'm gonna piggyback that statement is factual from my perspective, that credit cards are the devil. Here's why. As I said earlier, credit card. So remember, the rate that
I know where you're going.
Nah. The rate that the Federal Reserve is raising affects prime, right? So prime is what credit cards are based on. That rate before today was effectively zero, right? So why in the world are credit card rates still 25, 26, 27%? I mean, a good one is probably like 19%. If the rate that they use to base their rates off of from the Federal Reserve is effectively zero, why are we still paying 25%? I don't understand why Congress hasn't I mean, it's Congress, I get it, but I don't understand why. Yeah, right. I don't understand why there's not an investigation around credit card companies who are literally bilking people for billions of dollars for no reason. There's no reason to be charging us 25, 26% on the credit card rate when the rate that they use to base it off of was effectively zero. So I mean, they are getting pure profit from us. So I agree that credit card rates are the devil. I agree. 100%.
But you got to learn how to flip credit cards for your benefit. And I know a lot of people who do use points, but I also want to speak to those people who can't afford that, right? There's a lot of people out there who, they're listening to this podcast and they're thinking, I need my credit card to live. You guys are talking about these cars and you're talking about, credit cards paying you, and that's all well and good, but I need to survive. And so for you all who, are in that space, it's a very real space. And, we have to be sensitive to that. Some people absolutely need a credit card to just get through the month. If you are that person, that is, rewind this, listen to the earlier part. You should absolutely be someone calling the credit card company and explain your situation to them. People understand the credit card companies have real individuals who answer the phone and they can make decisions. It is not set in stone. I called a credit card company when I was in college, and I told them I didn't have any money. I was a college student, and I wasn't going to pay my credit card bill. And they were like, what? I was like, I'm not paying the credit card bill. I don't have any money. And I explained this whole scenario to them, and I told them, this is when Leon and I were really into finance. I mean, when I say Leon and I have been in finance for a long time, we were like heavy in it. And so I explained to them accounts to bad debt and how they have to write off, debt if people don't pay. I explained the whole thing to them. I said, look, I give you 10 cents on the dollar. I said, for every dollar I owe you, I give you 10 cents. The person put me on hold, came back, put me on hold again, came back. I asked for a manager. The manager came, told them the same scenario. Not paying you. This is why. But I will give you 10 cents on the dollar. I think we end up selling for 30 cents on the dollar. And so
saved you 70%.
Yeah, like these people, they want their money. And because like Leon said, they're operating pretty much from pure profit standpoint.
Sure.
They're willing to negotiate. And this is not, Investing Education Academy saying we guarantee they'll lower it. We are not. But we are saying it doesn't hurt to call the 1-800 number and ask. Mm-hmm. Especially those of you all who will be highly hurt by these rates, interest rate rates, considering you may be already carrying high credit card debt, or that you're going to have to use some of the credit cards to just survive this time period. If you already know it, make the phone call. It can't hurt. We really want everybody to do well in this environment.
Yep.
Oh, what did it do to my credit when I did that? It hurt my credit, and I knew it would hurt my credit, and I knew it would hurt my credit for 7 years. But when it hurt my credit, I took the hit. And I was 18, so I was like, I don't care. I mean, to be straight up with you, I didn't care. But it also it looked better than not paying them at all.
Mm-hmm.
And it brought that account, it showed the account is paid off. So it was a negotiated deal, but it still showed it's paid off. It didn't hurt like a bankruptcy. It didn't hurt like just going negative. It hurt like a payoff, like an arranged payoff, which is far less than anything else. And then I doubled back because we understood finance, and I did something that raised my credit score like 40 points within probably a few months. So it was an offset, and in the end, I had a higher credit score. So, if anybody's interested, again, we're going to start digging into budgeting a little bit more than we have. You'll hear us now dropping tidbits about budget, because we understand that everybody who listens to Investing Education Academy is just investing in the stock market. I mean, the same way we talk about crypto, we talk about land, all these things are really important in these time periods because it helps you fight inflation. It helps you fight these increases you're seeing in your credit cards. Because if you're getting an increase in your credit cards, you're probably not getting any increase in the interest you're getting at your bank.
No.
And you're thinking, oh, well, interest rates are going up, so my savings account probably is going to go up to like 4%. No. Your credit cards from the bank will go up 4%, but what the bank pays you is probably going to move. I would guess
it will. No, it may not move. They don't have, because those rates are not based on prime, right? So the rate that your saving account, your bank pays you in your savings account is their own. That's internal, right? It has nothing to do with the prime rate of the Federal Reserve. So they don't have to pass on this rate hike to us, which they're not going to do. They're going to raise our credit card interest rate, so we pay them more money, but they're not going to. Well, let me say not. Most likely, they're not. Most likely, they're not going to raise the interest rate on our savings account because they don't have to. Why would they?
Have to?
Yeah, why would they? Yeah, we're going to pay them more money. They're going to get more money from us from the credit cards, which pads their pockets. Why would they just give that back to us on the back end? They're not going to do it. Most of them are not going to do it.
It will cut into their profit margin.
Yeah, exactly.
Mm-hmm. And none of us are showing that we are troubled from having savings accounts. Right. I mean, Leon and I have been doing this for a long time, and we've been in the market forever. And I'll say it took us a long time to convince our friends to invest. Like a long time. And we know they're probably investing because of us just talking about it so much. But there are a lot of people that don't have friends like that.
Mm-hmm.
And they're just sitting around talking about debt and complaining, and it's this circle of pity. And in that space, we're really trying to tell you all, you have some level of control on where you put your money. And if you are paying these high credit card bills and you are still in a savings account and you are not invested in the market and you are not investing in cryptocurrency and you are not invested in real estate and you are not an entrepreneur, and I don't know, unless you just ask your job for a raise, I don't know where you're going to find new money.
It's a double negative because you're paying high interest rates on everything, on all your debts, and you're getting no relief from your savings account. So your savings account is staying exactly where it is, which is, again, you're getting eaten up by inflation there because inflation is 7%. Your account's paying you 0.05%, and all of your debt interest rates are going up. So you're paying more there too. So it's just a vicious cycle. That's why we say, you got to, if you can, like Brent said, call 800 number, try to lower your rate, refinance anything that you can. Because this is just the beginning. This is the first rate hike. We have 6 more potentially coming. So it's going to get worse.
And that's this year.
That's this year, right? Yeah. Yeah, that's a good point. So next year, it's projected they're going to do anywhere from 2 to, again, everything data dependent, whatever that means. But they're saying they're probably next year, they may do anywhere from 2 to 3 more rate hikes next year. So this is going to be an ongoing thing for at least the next year and a half. And you're going to feel it in your pocket by the end of this year, definitely, if you have outstanding debts.
Yep. So for everybody, again, thank you for being with us. We're doing this for you all. I mean, honestly, I am exhausted right now, but these are the things we're doing, hoping that you take this information and talk to other people about it. Talk to your family members about it. Don't just go, oh, that was cool.
And like we would say, don't gotta join IA, don't gotta join anything. If you want, just show them our YouTube, or pass these videos on to your friends and family from YouTube, right? Because this is all out here anyway. Now the more valuable stuff we do inside the platform, inside our membership platform. But again, we do this because we want to share this information with the world, especially in the minority community, but anybody in general who needs this information and needs this help. So definitely share all of these.
Yep. So everybody, enjoy your day. We hope to see you next Wednesday. And if you listen to the podcast, subscribe, share it with somebody, and make sure they subscribe too. Have a good day, everybody.